Market crash. Just hearing those two words is enough to make most people panic, right? But what if it didn't have to be that way? What if, and stick with me here, what if a downturn could actually be one of the biggest wealth-building opportunities you'll ever see? Well, that's exactly what we're going to break down right here.
And to guide us through this, we're looking at the experience of investor Mark Tilbury. Now, this is a guy who has spent more than 35 years not just surviving market chaos, but actually using it to get ahead. And what he's found is that these crashes, they aren't just random acts of disaster. They can actually be predictable, and more importantly, they can be profitable.
Okay, so here's our game plan. First, we're going to define what we're up against. Then, we'll walk through the 3 key stages of any crash: the euphoria, the reckoning, and what we're calling the phoenix. And finally, we'll wrap it all up with the one big idea you need to walk away with.
All right, first things first, let's get our language straight. Because, not every dip in the market is a full-blown catastrophe. You got to know the difference between a little stumble and a major free fall.
So you've got your basic correction. This is the most common one. Think of it like the market just kind of taking a breath, realizing things got a little out of hand. These happen all the time, about every 14 months or so. They're practically a normal part of the whole cycle.
Then you level up to a bear market. Okay, this is more serious, a drop of over 20%. But here's the really fascinating part. A bear market feels like forever, but on average, it only lasts about 9.5 months. The bull markets that come after it, they last almost 3 times longer. It just goes to show you, growth is the default setting. These downturns are just temporary interruptions.
And then you have the crash, the big one, a sudden terrifying drop of over 30%. These are the rare events that make all the headlines. So here's the bottom line. If you're going to invest, you have to accept that the market will go down. It is not a question of if, it is only a question of when.
So that takes us to stage 1, euphoria. You know, the big party right before the hangover? The trick here is to learn how to spot the warning signs that the party's about to end while everyone else is still dancing.
In this euphoria, it pops up everywhere. Just think back to the lead up to 2008. Credit was super easy, people were spending money like crazy, and it seemed like your neighbor, your cousin, everyone was flipping houses. Or how about just a couple years ago? People were dropping millions of dollars on JPEGs of cartoon apes. I mean, when your cab driver starts giving you hot stock tips, that's a 5-alarm fire warning sign that things are getting way too frothy.
You see, in these crazy, euphoric times, everyone wants to be the hare, chasing those insane, high-risk gambles. But the real winning strategy, the one that builds lasting wealth, belongs to the tortoise. The tortoise is all about slow, steady, sustainable gains. The hare might look good for a little while, but they get absolutely wiped out in the crash. The tortoise always wins the race.
So how do you make sure you're the tortoise? It comes down to 4 very specific steps. First, get real with yourself and assess your risk tolerance. Can you actually stomach a big drop? Second, cut down your leverage. Get rid of high-interest debt and especially margin loans. Those are absolute poison in a downturn. Third, and this one is huge, build a pile of cash. This isn't your emergency fund. This is your opportunity fund. This is your war chest for when everything goes on sale. And finally, number 4, diversify. You just never know which part of the market is going to get hit the hardest.
And that preparation leads us right into the hardest part of all, stage 2, the reckoning. This is it. The market is in a nosedive. Every news channel is screaming doom and gloom, and your gut is telling you to sell everything. This is the moment where fortunes are either made or completely destroyed. It's all about psychology. You know, it's one thing to call yourself a long-term investor when all your stocks are going up. It's easy then. The real test, the only test, is what you do when you see your portfolio get cut in half. The battle here isn't with the market. It's with the panic in your own head.
And if you need proof, just look at the brutal math of panic selling. This Fidelity study's just wild. It looked at the S&P 500 from 1980 to 2022. If you put 10 grand in and just left it alone, you'd have over $1 million bucks. But if you got scared and tried to time the market and you missed just the 5 best days, your return gets slashed by almost 40%. Miss the 50 best days, you've basically made nothing. It's definitive proof that trying to jump in and out is a loser's game.
So you've got 2 choices, 2 paths you can take. The panic seller listens to all the noise, gets scared, and sells at the very bottom, locking in those losses forever. The disciplined buyer, on the other hand, sees the exact same crash and thinks, hey, it's a Black Friday sale. They stick to their plan and start buying.
And this is why that opportunity fund we talked about in stage 1 is so critical.
When the crash happens, cash is king. It's the ultimate power. It's the ammo you need to go on an absolute shopping spree. Back in 2008, Tilbury used his cash to buy up stocks and even whole businesses for pennies on the dollar. While everyone else was running for the exits, he was loading up his shopping cart. So, after all that fire and chaos of the reckoning, we get to stage 3, the phoenix rising from the ashes. This is the recovery. This is where all that boring preparation and iron-willed discipline from the first 2 stages pays off in a way that can literally change your life.
I mean, just look at history. It tells the same story over and over again. After the shock of Black Monday in '87, the market went on a tear. After the dot-com bust destroyed all those early internet companies, giants like Google and Apple took over the world. The 2008 crisis felt like the end of capitalism itself, but it was followed by the longest bull market we've ever had. And the 2020 pandemic crash, that was followed by one of the fastest recoveries in history. The pattern couldn't be clearer. Every single crash, no matter how bad it feels at the time, has always been followed by a recovery that takes the market to brand new highs.
And this really gets to the heart of the whole thing, doesn't it? Real wealth, the kind that lasts for generations, isn't built when everything is easy and comfortable. It's forged in the fire of a crisis, when there's blood in the streets and you have the courage and the cash to buy when everyone else is terrified.
So what does this all boil down to? It's simple, really. It all comes down to how you choose to look at things. It's not about trying to avoid the downturns. You can't. It's about completely reframing them in your mind.
Look, the next downturn is coming. That's a guarantee. It might be next year, it might be in 5 years, but it will happen. So the only question that matters is, when it gets here, who are you going to be? Are you going to be the person who panics? Or are you going to be the prepared tortoise who sees it for what it really is, the greatest sale of your entire investing life? The choice is all yours.